Hello. Europe just put in another strong week, with stocks sitting near record territory. And the weird part is that the headlines never really got calmer. Yet the market acted like the earnings outlook mattered more than the risks on the page. By the end of this, you'll have a simple way to read Europe near highs as a tug-of-war between earnings revisions and the risk premium, and you'll know exactly what to watch next that could flip the story. On Friday, February 20th, the STOXX 600 finished at a record, capping a week of gains. A few days earlier, on February 18th, it also closed at a record after a sharp jump. Then on February 19th, it slid back as investors digested a mixed run of earnings. So you get this three-step sequence that feels familiar. A record close, a wobble, and then strength again. That sequence is the whole point, because it tells you what the market is willing to forgive and what it isn't. When people say the index is near highs, it sounds like a single opinion, like everyone just woke up optimistic. But an index at highs is really two things at once. First, it's a statement about expected cash flows, the earnings path. Second, it's a statement about the price of uncertainty. How much return investors demand just to hold stocks. If you want one clean sentence, it's this. Prices rise when investors either expect more earnings or they demand less compensation for risk. And this week, Europe behaved as if the earnings path was improving enough to keep the rally intact, even while headline risks stayed noisy. That doesn't mean the market thinks risks are gone. It means the market is choosing for now to price them as manageable, unless something forces a repricing. So what is the something? There are three common explanations for a market near highs in an environment like this. One, it's earnings reality. Companies are guiding in a way that supports the year ahead. Two, it's rate hopes. Investors think the discount rate is about to ease, so multiples can stretch. Three, it's a risk premium puzzle. The risks are still there, but they're being paid inside the market through sector leadership and rotation, instead of through an outright drop in the index. All three can exist at once, but usually one is doing the heavy lifting. A good way to tell is to stop looking at the headline level of the index and start looking at leadership, because leadership is the market's confession. On February 18th, the STOXX 600 closed up 1.2% at 628.69, and defense and banks were in the lead. That matters because those aren't the sectors you'd expect to dominate if the story was simply AI is back and risk is off. Defense is, by design, a sector that lives with geopolitics. Banks are, by design, sensitive to the path of rates, but also to economic activity and credit risk. So if defense and banks are pulling the index higher, the market is telling you something specific. It's not just chasing the most exciting narrative. It's pricing cash flows and balance sheets. Insolvisi soren and it's thinking the near-term macro backdrop isn't collapsing. That's the macro-to-equities translation. Headlines can scream, the index can still grind higher if the earnings revisions stop getting worse. And that's why this week's rally can coexist with tensions and focus language. Now add one more ingredient: surveys. On February 20th, the HCOB Flash Eurozone Composite PMI rose to 51.9 from 51.3. Manufacturing moved back into growth, with the manufacturing PMI at 50.8. PMIs aren't earnings, but PMIs are the first draft of demand. They are the market's early warning system for whether guidance confidence is likely to hold. When PMIs move up and stay above 50, management teams are more comfortable saying demand is steady, or orders are improving, or we still see the year playing out. And when PMIs roll over, the tone changes first, then the numbers. So PMIs sit right at the hinge between macro and equities. They don't tell you where stocks must go. They tell you whether earnings risk is rising or falling. Now, if you're watching the market like a story, you might be tempted to reduce everything to a single narrative. Europe is near highs because rates are coming down. Or Europe is near highs because earnings are strong. Or Europe is near highs because investors don't care about risks. All of those can be partly true and still mislead you. The more useful approach is to treat the market like a pricing machine. It is constantly updating two knobs: expected earnings and the required return. And the required return itself has two parts. There's the risk-free baseline, what you can get from safe government bonds, and then there's the equity risk premium, the extra return investors want because stocks can disappoint and the world can get messy. So when you see stocks at highs, ask a plain question. Did the market lift the earnings knob, or did it lower the risk premium knob? If the answer is rates, you usually see it in broad multiple expansion. The rally becomes wide, and the most rate-sensitive areas often lead. If the answer is earnings, you usually see it in guidance language and in the way investors punish misses. Good results get rewarded, cautious outlooks get hit, the the market becomes picky. If the answer is risk premium being paid inside the market, you often see something else. The index looks calm, but leadership turns defensive. And defense and energy do well. The market keeps one eye on uncertainty, and rallies feel like they're happening with a helmet on. That last phrase matters, because Europe can rally while still paying for risk. It can do it by rotating into sectors whose cash flows are less fragile. And that is exactly why defense keeps showing up as a lead character. Look at BAE Systems. It reported better than expected results, and its order backlog hit a record £83.6 billion. You don't have to know every line item. You just need to understand what that backlog means in market language. A backlog is a promise of future revenue, not guaranteed, but visible. When backlog rises and stays high, the market treats part of the cash flow story as pre-funded by demand. So in a week where geopolitics is in focus, a name like BAE becomes a kind of bridge. It benefits from defense spending, and it looks less dependent on the next consumer sentiment print. This is why the rally doesn't need an AI narrative to stay alive. Europe has AI exposure, of course, but a lot of index weight and leadership can come from banks, industrials, defense, energy, and staples. Sectors where the question is not who has the best model, but who can protect margins, who has pricing power, who has demand visibility, and who is least fragile if growth is just okay. That's also why AI narrative fade can be a red herring in Europe. If AI hype cools, it doesn't automatically break an index where leadership is anchored in different cash flow engines. Now, none of this is a promise, because this translation breaks the moment the market decides earnings aren't safe, or the moment the risk premium needs to jump. And those shifts can happen quickly. You saw a small version of that on February 19th. The STOXX 600 closed down 0.5% at 625.33 as investors sorted through a mixed set of earnings. It wasn't a crash, it was a reminder. In a market near highs, mixed earnings becomes the trigger for repricing. Not because the level is fragile, but because expectations are. When an index sits near record territory, the margin for error shrinks. So the market starts asking sharper questions. Is this company guiding down because of a one-off issue or because demand is rolling over? Are margins compressing because of costs or because pricing power is gone? Are buybacks continuing or being paused? Those are not dramatic questions, but they decide whether earnings revisions stay stable. And those revisions are the oxygen of a rally like this. Now zoom back out. What could change next? Two things, mainly. First, growth surveys and activity data. PMIs are the headline version, but the broader idea is simple. If forward-looking surveys soften, investors stop giving the benefit of the doubt on guidance. And in that moment, the market starts to reprice earnings risk. Second, geopolitics, specifically through the channel that hits cash flows the fastest, energy. Geopolitics is always in focus in the news. But in markets, it becomes urgent when it changes input costs, demand, or funding conditions. Energy is the cleanest transmission mechanism. On February 19th, energy stocks rose alongside higher crude prices. That's not just a sector fact, it's a signal about what investors are hedging. If the index is near highs and energy keeps outperforming, it often means investors are paying a higher risk premium. But they're paying it by owning the hedge, not by selling the market. Defense works similarly. If defense keeps outperforming into record highs, it suggests the market is not in a pure risk is gone mode. It's in a risk is manageable, but we're staying positioned for it mode. That's a different kind of rally. It's less about euphoria, more about selective confidence. Now, what about just rate hopes? Rates still matter, even if they're not the whole story. Banks, for example, can benefit when the macro looks steady and the rate path looks predictable. But the key is to avoid assuming that every rally is a dovish story. If the rally is only about rates, you usually see a more uniform lift across the market. If the rally is about earnings, you see dispersion. And winners and losers. And if the rally is about risk premium being managed internally, you see it in the relative strength of defense and energy even when the index is calm. So here's the falsifiable part, the part that doesn't rely on vibes. If the next round of surveys holds up, PM is stay above 50 and the language from companies stays steady. The earnings reality explanation keeps working. If surveys roll over or guidance starts to turn cautious in clusters, the market will stop paying up for the same earnings and the index will feel heavy even if rates are stable. And if geopolitical risk transmits into energy prices in a way that threatens margins or consumer demand, the risk premium can jump quickly, and sector leadership will probably look even more defensive before the index itself breaks. That's the setup. Europe near highs is not a single bet. It's a balance. It's investors saying earnings risk looks contained enough to keep the tape firm, and the risks on the page are either hedged or postponed. So what should you watch next? First, the next PMI and growth survey prints. Not for perfection, for direction. Do they stay in expansion, or do they slip back toward contraction? Second, earnings guidance tone. Not the headline EPS beat, the words about demand, margins, and confidence. Third, relative strength in defense and energy. If those sectors keep leading while the index stays near highs, that is the market paying for risk without admitting it. And the reusable takeaway sentence is this: when an index is near highs, stop arguing about the headline and ask what is being revised, earnings expectations or the price of risk.